The average person out there has been trained by 40 years of benign markets to be too aggressive. The average guy out there needs to have 10% of his or her portfolio in cash, which is to say the best thing to do if you have 10% cash in your portfolio is to leave it as liquidity. I've always been fairly liquid in my own portfolio. And while I understand perfectly that the interest rates, the deposit interest rates that we're enjoying right now, if that's the phrase, mean that you absolutely positively lose purchasing power every month by maintaining cash, what you have to think about is that the negative interest rate that you suffer is an option payment for having liquidity, which might give you courage to take advantage of circumstances like 2008 rather than being taken advantage of.
Yeah.
And so if the number is really 10%, my suggestion is that people leave it in cash. Getting back to the intent of the question, I think there's three answers. Most people have been too aggressive, I think. And for most people, their primary resource activity, the thing that they need to increase their exposure to, I'm not necessarily talking about your subscribers, but the average person out there, is that most people are underinvested in gold. Gold is financial insurance. It's catastrophe insurance. Gold is an asset that you own and you hope it doesn't go up in price, because the circumstance that makes it go up in price beats the hell out of the rest of your portfolio. And by the way, scares you to death about your life and your kids' life. If you've taken care of that as an investor and you're a younger person, I still believe that the best risk to reward juxtaposition in mining shares is in the uranium space. I don't see any way over the next 5 years that the uranium price in real dollars, in constant dollars, not nominal dollars, doesn't go from $47 to some number like 70 or 75, the incentive price for new production. So the idea that the commodity price has to go up, by 30 or 35% has to over 5 years. And the idea that most likely will see its way through to the equity prices means that for speculators who have the 2 to 5 year time frame, that the easiest speculative opportunities are still in the uranium space. If it's a different investor still, if he's an old, bald, fat, rich, white guy like me, where perhaps although he doesn't need income, he likes income, then I would suspect that you either want to be involved in the very high quality oil and gas names that have enough free cash flow that they can maintain their sustaining capital investments plus return a yield to their owners, or that they become involved in bad markets, in the natural resource bond market, the short-term bond market, or in some of the various private credit programs around oil and gas, around oil and gas and mining. Most investors in our space are so focused on the upside that they don't understand that most of your job is reducing your downside. And so depending on who the investor is, the answer could either be gold, or if he or she is a wild speculator, uranium, or if he or she either likes or needs income and has an orientation towards safety, being on the debt side of the capital stack is the best place to be. Remember that on any individual balance sheet, the worst piece of debt is better than the best piece of equity. Always remember that.
Rick, in my first year of speculating in junior resources, I memorized a bunch of Rick Ruleisms. And one of them I remember about your downside was, I'll give you half of my upside if you take away all of my downside. So that was a memorable one.
Every day of the week. Every day of the week.
Yeah.